Every man is the architect of his own fortune. Hello, happy people. Thanks for tuning in for this video, which is about the rules 6 of the top investors in the world live by. Without wasting much time, let's get started. First, Warren Buffett. Warren Buffett is considered as one of the most successful investors in history, with net worth of over 85 billion US dollars, making him the fourth richest person on earth. He famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Buffett's rule is that he only invests in his circle of competence. Circle of competence is the subject area which matches a person's skill or expertise. Buffett wants every investor to limit the financial investment in areas where an individual may have limited understanding or experience, instead investing in the companies which are familiar and lie within the circle of competence of the individual. As we know, Roger Federer is one of the greatest tennis players of all time. So his circle of competence is tennis. So, according to Warren's rule, he should invest in the companies around tennis, like racket companies or the companies which manufacture shoes for tennis. And as Warren said in his 1996 shareholder letter, that what an investor needs is the ability to correctly evaluate selected business. Note that word, selected. You don't have to be an expert on every company or even many. You only have to be able to evaluate companies within your circle of competence. The size of the circle is not very important. Knowing its boundaries, however, is vital. Second, Carl Icahn. Carl Icahn is an American investor and a very successful corporate trader. He has an estimated net worth of $17.5 billion. He takes over big companies which are poorly run by buying stocks, then using ownership positions to force changes to increase the value of shares. Icahn is famous for the Icahn lift. This is the Wall Street catchphrase that describes the upward bounce in the company's stock, which happens after Icahn starts buying stocks of a particular company which he believes is poorly managed. Icahn has said, "My investment philosophy, generally with exceptions, is to buy something when no one wants it." Icahn rule is, investors should be wary of two cardinal sins: acting impulsively and not acting at all. An investor should stay calm and patient and not make any investment decisions impulsively. At the same time, he or she should also be aggressive when it is time to perform. Third, Peter Lynch. Peter Lynch is an American investor who managed Fidelity Investment Fund from 1977 to 1990, during which the fund's assets grew from $18 million to $14 billion. More importantly, Lynch beat the S&P 500 index benchmark in 11 of those 13 years, achieving an annual average return of 29%. He famously said, "In the stock market, the most important organ is the stomach, it is not the brain." By this quote, what he means is, people who don't accept volatility and can't handle it should look elsewhere to build wealth. Lynch also said, "You have got to look in the mirror every day and say, what I'm going to do if the market goes down 10%. If your answer is to get out of the position, you should reduce your stock holding." Emotions can be real performance killer. If market drops get you selling out in panic, or market surges make you greedy, then you are not made for this business. Fourth, George Soros. George Soros is the founder of hedge fund Soros Fund Management. He is considered master at translating broad brush economic trends into highly leveraged killer plays in bonds and currencies. He has a net worth of $8.6 billion. He is known as the man who broke Bank of England because he shorted British pound in 1992 and made a profit of $1 billion US. Soros is a short-term speculator. He makes massive, highly leveraged bets on the direction of the financial markets. His famous hedge fund is known for its global macro strategy, a philosophy centered around making massive one-way bet on the movement of currency rates, commodity prices, stocks, bonds, and other assets based on macroeconomical analysis. He refers to his philosophy as reflexivity. Fifth, Carlos Slim. Carlos Slim is a Mexican business magnate and investor. He was the richest man on earth between 2010 to 2013. He has a net worth of $68.9 billion. He accounts for 40% of listings in Mexico Stock Exchange. Slim's portfolio is much diversified. It includes real estate, retail, telecom, mining, financial services, tobacco, aluminium, tires, copper, insurance, restaurant, oil and gas, paper, hotels, and more. People in Mexico say you can't live a day without somehow giving money to Slim's empire. He said, "Bad times can present opportunities. All times are good times for those who know how to work and have the tools to do so." Bad times not only present the opportunities to grow your wealth if you are willing to work at it, but also to do good for others if you have the opportunity to help. So use the tools available to you and aim to make both your portfolio and the world you live in stronger and better when things get tough. Sixth, Rakesh Jhunjhunwala. Rakesh Jhunjhunwala is an Indian investor with a net worth of over $3 billion. He manages his own portfolio. He said, if you don't believe the markets are supreme, you will never admit that it was your mistake. If you don't admit that it is your mistake, you will never learn. To succeed in the stock market, the ability to learn from one mistake is vital. He also said, respect the market, have an open mind, know what is at stake, know when to take a loss and be responsible. He feels every investor should do his own research and analysis and bet on your gut. If you lose, learn from it and move on. Learning from your mistake is the most important thing.